Welcome to the video, guys. Thank you so much for clicking onto it. Today we're going to be talking all about mortgages. So if you're not really interested in mortgages, probably not the best video for you. We're going to be focusing on an interest-only mortgage and a capital repayment mortgage and why you might want to choose one over the other. But before we get into it, if you wouldn't mind just smashing the like button and hitting the subscribe button, that'd be very much appreciated. So for those of you that don't know, a mortgage is something you use. It's essentially a loan from a bank. So for example, if you want to buy a house for £100,000, most people will not have £100,000 to buy the house outright. So what they'll do is get a mortgage. So say for example, they buy the £100,000 house, but then they've only got £10,000 to put down as a deposit. So they'll pay £10,000 out of their own money and they'll get a mortgage for the 90% of the property that they can't afford, the other £90,000. And then the person buying the house will then pay back the loan every single month over a given time. So typically this can be as low as 15 years or it could be up to 40 years, depending on what you want to do. And when you take out a mortgage, there'll be things like credit checks, and the bank will do lots of checking on you to make sure that you are able to pay the bank back, because last thing they want to do is loan out £90,000 and then a few months into it you can't pay, which is going to cause them real problems. All banks are interested in is giving out money, loaning it to someone and making money on that, so that if they're loaning out £90,000 in this case, they want to make a profit and maybe make £100,000, £110,000 over the term of the mortgage. So there are two main types of mortgage. There's capital repayment and interest only. With interest only, all you'll be doing each month is paying off the interest on that loan. So at the end of the 30 years, you still owe £90,000. Whereas the capital repayment is slightly higher per month because you're actually paying down some of the balance of that £90,000. So again, over 30 years, each month you'll be paying a bit of that £90,000 back to the bank that originally loaned it to you, plus the interest on top of that. So if a mortgage payment each month is, say, £200, £250, the capital repayment might be something like £400 to £500, depending on the interest rates and things like that. So instantly, the capital repayment, it's going to be a higher expense every single month. But at the end of it, you own the house outright. You don't have to pay back the whole loan that you originally took out. And that is one of the big reasons why a lot of people that buy houses, either for investing or for themselves, choose to go through the capital repayment, because they want to essentially pay off the balance over the term of the mortgage. And in theory, an interest-only mortgage is more risky because you get the end of the term, 30 years, and if you don't have the £90,000 in this case to pay back the bank, then you could be in real financial difficulty. So in general, the capital repayment mortgages are used mainly when people buy their homes to live in. They're not renting it out. They just want to own a property, and at the end of the term, they've paid off the loan and they own it outright. Whereas investors tend to buy a property with an interest-only mortgage rather than a capital repayment. And the main reason for that is because it reduces the monthly mortgage costs. So if the rent is £1,000 and the mortgage is £300 a month, interest only, they're making £700 profit per month. Whereas if it was a capital repayment mortgage, then it might be more like £500, £600. So their profit each month is dropping from £700 to around £500. So that's one main reason why interest only is preferable for buy-to-let mortgages. Another reason is, say for example, you buy a house in 2000 for £100,000, and with the buy-to-let mortgage you put 25% down, so you've put £25,000 and then the bank has loaned out as a mortgage £75,000, and then you take it out for 40 years. So over 40 years, you're just paying off the interest to the bank, and in 2040, you'll then have to pay the £75,000 of that £100,000 back, which on its own sounds quite scary. However, over the last 1,000 years, on average, property prices double every 10 years. So in 40 years, property prices will have doubled 4 times. Now this is going to test my maths. So in 2010, if on average it might go higher than this, might go lower. So if you bought the property in 2000 for £100,000, in 2010 it'll be worth £200,000. In 2020 it'll be worth £400,000. 2030 it'll be worth £800,000, and in 2040 it'll be worth 1.6 million. It could go down, it could go up. Although property prices do vary, they do on average over time increase. And there's two main reasons for that. Firstly is inflation, and secondly is that there's only a fixed amount of space where the houses can be built. And there's plenty of people trying to move to the UK, so our population is increasing, the demand is increasing for houses, the supply is pretty constant, which is what is driving up the property price. So if you bought a house in 2000 for £100,000, it could be worth 1.6 million in 2040. The beauty of that is when you get to the end of the mortgage term in 2040, you still owe the £75,000. It's not based on the value of the property, it's based on the loan amount. So what you can do, there's two things you can do. You can just sell the house for say 1.6 million and use part of that just to pay back the original loan, and you'll still have 1.525 million pounds left, which is not bad when you've put in £25,000 at the beginning. Or you can remortgage, so you just take another mortgage out with the same bank or a different bank, say for a 75% mortgage, and use that 75% to pay back the loan of the original mortgage, which will be a very small fraction of that. I'm not going to try and work it out now. And then you've got the profit, which you could then use to buy other properties with the money. That's the main reason why investors use buy to let, because of this property price increase and the cash flow each month, which means each house can make more money, which they could then use to buy other houses. And the common advice with property investing is use an interest-only mortgage because of these reasons that I've just gone over. And I agree, and it's something that I do with my investments. However, this advice fails to take into account that each person is completely different. I know some people that are very risk averse, and buying a property to invest would be really, really stressful for them. The last thing that they would want to do after buying an investment property is to have an interest-only mortgage. They're happy to make less money with the security and the safety net, but at the end of the mortgage term, they will own the property outright and there's no risk. And that's really the way up. Do you want to have a bit higher risk and make more money, or do you want a lower risk, make less money? And it's really down to each individual as to what they want to do. This is just what I do, this is what most investors do, use interest-only mortgages. Now that we've gone over the two different types of mortgage and why you might choose one over the other, I will say this, that we are taught in school and as a society that debt is bad, but there are actually different types of debt. There's good debt and there's bad debt. So good debt is, for example, getting a mortgage on an investment property, because that debt is allowing you to make more money every month. So with a rental property, you pay your mortgage payment, your interest only, and you get the difference between the rent and the mortgage payment, and that's your cash flow. Whereas bad debt is if you say buy a car on a loan and you have to pay that back every month, because that isn't making you any money. So I think when people say debt is bad, yes, most debt is bad, or a lot of debt is bad, but there are times where debt can be used in a good way to generate wealth and more money. And that is something that a lot of wealthy people take advantage of, using good debt to leverage their money to then create more cash flow. So thank you so much for watching, guys. If you did enjoy the video, please do like it. If you do have any questions regarding mortgages, please comment down below, or anything property related. I will do my best to answer them. And please do subscribe if you find value, and you can be notified when the next video comes out. Cheers, guys, and I'll see you in the next one.